I think the 200 to 250,000 for Bitcoin still makes sense because that would still only value it at 25% of the size of the gold market.
Okay.
So I think digital gold means Bitcoin should be worth over $1 million per Bitcoin, and it could happen in the next few years. But maybe pricing 25% of that, especially with Genius Act, makes sense.
Tom Lee makes a bold yet methodical case. Bitcoin reaching $250,000 remains a rational forecast, not a moonshot. At just 25% of gold's market cap, BTC would already be valued in the hundreds of thousands. But in Lee's view, digital gold should actually command a valuation north of $1 million per coin in the coming years. What drives this prediction isn't just supply mechanics, but the global macro backdrop: runaway debt, inflation pressure, and fiat instability. In this context, Bitcoin becomes not just an asset, but a global monetary solution. Ethereum, meanwhile, emerges as the infrastructure layer of the crypto economy. Stablecoins, minted mostly on Ethereum, are seeing explosive growth, prompting even JP Morgan and Citibank to enter the space. According to Lee, this convergence of monetary and technological forces points toward an exponential repricing of both Bitcoin and Ethereum, forming the foundation of the next crypto-driven financial revolution.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
I think the 200 to 250,000 for Bitcoin still makes sense because that would still only value it at 25% of the size of the gold market.
Okay.
So I think digital gold means Bitcoin should be worth over $1 million per Bitcoin, and it could happen in the next few years. But maybe pricing 25% of that, especially with Genius Act, makes sense.
Are you going to, I don't know, start making comments and recommendations about stablecoins?
Yes. I mean, in a sense, stablecoins are the ChatGPT moment for crypto because businesses like it and consumers are adopting it. And now we see JP Morgan and Citi and getting into the stablecoin market, and the Genius Act, of course.
How would you play that?
Well, Circle is one way because it is, a standout company. They've done really well. But Ethereum is really the way to play stablecoins because the majority of stablecoins are created on Ethereum. It's over 30% of its network fees. And if Scott Bessent's right in it, he says now it's close to a $4 trillion market. That's exponential growth for Ethereum.
Ether has taken off recently. It was down at 1,700 or something like a month ago or 2 months ago.
Yes.
Now it's back almost, 36 or something?
That's right. And I know Mark Newton, our head of technicals, thinks it's 5,000 is doable near term, but if you value it similar to Circle, it's more between 10 and 20,000.
You give a rat's patootie about August 1st? Does anything change with that for you?
Well,
a new month.
Yes.
Is that that's what you're gonna? That's your answer? Well, it's a new month. Yeah.
I mean, I think that on the half full, the tariffs are really good for the budget. So, and companies are managing through these now, and they're pretty significant now. And it's not inflation. They're not talking about it as inflation. So that's the half full. But you're right. Maybe August 1st gets pushed again, and that would also be positive. What we're saying is instead of someone saying, oh, the MAG is making the market expensive, let's just take the average PE of the S&P of every stock. And it was around 17.6 times in 2019. Now we've had 6 what I call extinction-like events. COVID, the bullwhip supply chain effect, inflation surge, Fed fastest hikes, Trump tariffs, and then, of course, U.S. bombing Iran.
6 of them, yeah, okay.
Yeah, all of them should have wiped out earnings, but the S&P earnings have grown, and yet the equal weight PE is now 16 times. So the market's gotten cheaper in the last 6 years, despite proving they can grow earnings through 6 extinction-level events. I think many people, when April happened and we had Tariff Armageddon and the market went into a free fall, investors liquidated because they thought we were entering a recession. But, and as you guys had covered, the market then staged a V-shaped recovery, which caught many people off guard because they wanted to have a chance to get in. They wanted the stock market to be like a K-shaped or flat line. Instead, it was a V-shaped bounce. And so most investors are underexposed at the moment. And they're trying to look at headlines with a half-empty view. But as you guys know, earnings have actually been really resilient, and I think it tells a very good story. Markets made new highs this week. I don't find a lot of people cheering and happy. Most of our institutional clients are skeptical of this recovery because they feel that there's still looming uncertainties, whether it's the FOMC or the tariff deadline. So, as you know, markets don't peak when investors are skeptical. They peak when there's over exuberant enthusiasm. There's no signs of that today.
They're not wrong with wondering about the uncertainty relative to those issues, are they?
They're not wrong, but I think it's the amplitude that people got wrong. So in April, people thought if you didn't have a trade deal, we'd have economic Armageddon. But now what they're finding that is if you're wrong, it's just we don't have to fall off a cliff. And so there can be diplomatic solutions or even pushing off deadline.
Lee explains that stablecoins represent crypto's ChatGPT moment, rapid adoption, real utility, and institutional endorsement. Ethereum is at the center of this transformation, with over 30% of its fees tied to stablecoin activity. Lee highlights Circle as a standout stablecoin company, but insists the real play is Ethereum as it captures the lion's share of transaction volume. Ethereum's exponential network effect, growing on-chain finance, and the rise of staked Ethereum are all structural tailwinds pushing the asset to potential price targets between $10,000 and $20,000. Ethereum is no longer just a tech story, it's a monetary one. Meanwhile, Lee reminds investors that macro fears, tariffs, Fed hikes, geopolitical shocks have been wrongly interpreted. Despite 6 extinction-level events in the past 6 years, markets have grown more efficient, not weaker. In crypto and equities alike, Lee sees undervalued resilience. Institutional skepticism, ironically, is the signal of a market still climbing a wall of worry, not nearing a peak.
I wouldn't call it the most hated bull market, but I would say a lot of people are looking for a pullback. They're talking about things being overextended. They're talking about uncertainty with the Fed and earnings and lions and tigers and bears. Oh no. I don't know what the short term holds. I think we could see a consolidation. It's really unclear for me, but the underlying fundamentals still strong. We do think the Fed will certainly have to be dovish in the next couple of months. And what we also think is that rates are going to rally because the deficit, in all likelihood, while not going to be good, will probably be better than expected based on some of the tariff news that we're getting.
I mean, this guy is known for being like one of the most bullish people around.
Yeah.
You've been right there riding shotgun with Tom Lee the whole time.
Yeah. I think we were on the show and we were talking about 5,000 being the bottom. Uncertainty was overblown, and this was a time to get more bullish, and the AI trade was one way to do it. We're still there, and we've been talking about how does the AI trade break, how does it pull back. We've been looking at a lot of different things, and one thing I think that's could potentially hurt the AI trade is if you do get the Fed cutting, if growth is better than expected, if rates do come down, suddenly the contrarian trade starts to look better and you could see a rotation. And I think that's the biggest fear for AI right now.
We're still early in a multi-asset bull cycle powered by digital transformation and misunderstood macro trends. Investors remain underexposed, scarred by recent downturns and fixated on short-term risks. Yet the structural setup favors assets like Bitcoin and Ethereum, which benefit from liquidity expansion, digital adoption, and monetary distrust. Lee argues that Bitcoin is eating into the gold narrative, and Ethereum is quietly absorbing the utility premium of the entire digital economy. The Fed, he believes, will be forced into a more dovish stance, while rates could fall and deficits improve, setting the stage for a surprise rally. Crypto, AI, and stablecoin rails are merging into a new paradigm. Those waiting for clarity may find themselves priced out of the next wave. Lee's final message is simple but urgent. Don't underestimate what Bitcoin and Ethereum can become when the world finally realizes their role is not speculative but foundational.